Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and investment expert, Zach Lemaster. Now, Zach is a seasoned real estate investor that has accumulated a large portfolio of rental properties across multiple markets, including single-family, multifamily, commercial, and new construction. Now, Zach started his real estate investment journey while working as an optometrist and captain for the U.S. Air Force. The cash flow from his real estate investments eventually allowed him to retire early from his career in medicine to be a professional investor by strategically investing in markets that maximize cash flow, appreciation, and equity. And so with that, guys, it's my honor to welcome my guest for today's show, Zach Lemaster. Zach, how you doing, my friend?
Kevin, thanks for having me. I'm excited to be here. That was quite the introduction. A lot to talk about. We're very excited.
Yeah, no, I'm excited to have you here as well. And, you've got a lot going on, fingers in a lot of different pots. One of the most exciting pots that we're going to chat about here on the show will be the build to rent model, which again, I'm not going to spoil it too much because I want to get a little bit of your background before we go down that rabbit hole. And so why don't we start there, Zach? I think that's the best place for everyone that doesn't know you, doesn't know who you are, doesn't know your story. Take a few minutes, tell us a little bit more about yourself and ultimately, again, how you found your way into the real estate world.
Yeah, absolutely. I own and operate a company called Rent to Retirement. We're a turnkey business. That's our main involvement in the active side of investing, where we rehab or build properties in markets to allow investors to acquire and these are mainly single family or small multifamily, allow them to passively acquire their own portfolio. And that's really that business really developed, Kevin, out of the nature of our own success investing and being able to exit kind of that career path in the healthcare. So as you mentioned, I have a background as an optometrist. I was in the Air Force for 7 years. I was on scholarship. So I met my wife in Portland, Oregon. That's where we went to professional school, went into the Air Force for 7 years after that. The entire time I was investing in real estate. And it was slow. I mean, we're just doing single family, buy a duplex, live in half, rent out the other half, trade up over time. Every single year since we bought that first duplex, we've always scaled up and bought more and more real estate the following year. And so that's always been a goal of ours, and we've held true to that. We got to the point, well, after I left the Air Force, we did move to Colorado and opened up private practices and operated in that capacity for a while. Still, the entire time, building our real estate portfolio to the point where we were able to replace our active income as doctors. And so that really was eye-opening to a lot of people that are friends and family and colleagues that were interested in saying, hey, we want to do the same thing you're doing, but we don't have the time, the knowledge to know how to do that. And so that kind of was a birthplace of Rent to Retirement, where we could walk people through our process of acquiring cash flowing rentals in some of these markets we work in. Mm-hmm. And so that's kind of our history, our background and history on our personal path. And then kind of where we're at today is, we buy a lot of commercial assets, as we were talking, this is commercial retail mainly in really attractive markets. These are stabilized assets. We're not doing value adds. We're just buying assets that we can use cost segregation studies on, reduce our taxable income, and that are going to allow us to continue to grow our portfolio. So yeah, I guess that's about as quick of history as I can give you.
No, I appreciate that. And I just want a little bit more context there of your transition from running your own practice to being a full-time real estate investor. How many years did that actually take, of running your own optometry practice to truly throwing in the towel or selling whatever you did there to exit out and then going full-time real estate?
I mean, it was a slow transition where I didn't want to give that up. That was a big part of me. I went to school for 8 years.
Absolutely. That was a life commitment.
So it was hard to fully let go. I mean, I did get to the point where I just had to make a clean break, and we still do volunteer basis, international humanitarian missions and whatnot. And I was practicing in the Air Force as well for 7 years. And so that was a majority of my career path. We were buying rentals that entire time, and we operated in private practice for about 5 years, I would say, before I, really made that clean break. And then I got down from 5 days a week to 4 to 3 to 2. And then I, made that transition out. My wife, she still practices, a couple days a month, but, that's just because she likes to. But yeah, it was kind of slow to let go, even though we could financially do that over time.
So was there an actual true exit from your private practice, or is that just basically what your wife is carrying on right now?
No, those clinics were sold off. They're doing great. Good. And made a clean break. That's a tough I mean, that's a big thing about the healthcare professions. I think a lot of people find themselves, having to wear multiple hats when you have clinic ownership, because you're the practitioner, but you're also running a business if you're in private practice. And it's becoming more and more difficult over time to do that with, insurance. We won't go down that path, but
Yeah.
yeah, it's a challenge.
Yeah, no, absolutely. Well, good deal. Well, I know we were chatting a little bit about all the various things that you've got your hands in. I definitely want to talk about, where you're putting the money outside of your company, right? Like you guys mostly are a turnkey provider. You got other projects happening, but you'd like to take a lot of your own profits and proceeds from the deals you're doing with inside your business and put them into retail investments. And so I definitely want to go there, but not right now. What I want to talk about is the exciting world of build to rent. And I know that you guys are focused on Cape Coral, Florida, which is down southwest part of Florida, about 2 hours, 2.5 hours south of Tampa Bay area. And so we'll love to get some better insights there as to what you guys are working on down there, why the build to rent model. And so I'll let you kind of take it from there. Just give me the why first and foremost, and then we can kind of dive into the various intricacies of build to rent and why it's such a great model.
Absolutely. I mean, there's so much to cover in that very high level. When you have a brand new property, there's a lot of benefits with that. It's often difficult to have new construction that is still positive cash flow, simply because of construction, land costs, things like this. And so kind of our goal, Kevin, is to identify markets throughout the US where we can come into an area, have a build to rent model for investors to participate in and to purchase, where they can still have positive cash flow, strong appreciation, low maintenance because you have builder warranties, it's a brand new built house in an area where we're going to have high quality tenant demographics. Still positive cash flow. Again, that's the number one metric, which is hard to do in a lot of places. But in addition to all of that, especially in markets that are in the path of progress, and there's a huge housing shortage like Florida, you can come into often quite significant immediate equity. The houses we're building, call it a 4.2 right now, 1,800 square foot house that's going to rent out at $2,400 a month. That's all in for around $300,000, and it will appraise immediately in the 350 to 410 range. And that is something, it takes a year for them to be built. Of course, that's the downside. You have to be patient, but that's a really unique opportunity. And we're doing a lot of these. We're going to keep in our own portfolio, sell retail, but participation with investors is an opportunity where they can have immediate equity to either do a cash out refi, pull a lot of their money back out and reinvest it and be creative. They can sell it at a gain. But we really like areas where, I mean, there's a population shift, and I think we're all aware of this, where a lot of people, and this has been going on for a long period of time, people moving down to the Sun Belt, but especially areas that are more business, landlord friendly, more affordable. Texas and Florida are where we see huge population trends, and there's a huge housing shortage. No state income tax in these areas. So we just see this huge migration, especially as people are selling their houses in very expensive areas, coastal cities. And COVID just expedited this. I mean,
Yeah.
COVID was like the catalyst to make this, be much more of a aggressive trend, I guess I would say. And so we want to be in the path of progress of those areas where there are housing shortages, and people can ride that appreciation wave up, still making sure that the property's cash flow. Built to rent is an exceptional opportunity where you can have a brand new construction house. In the turnkey business, we do a lot of renovations on older houses, but it's important to look at location, make sure they're in a good area, but no matter how much renovation you put into a 1930 house, there's still going to be deferred maintenance and things like this. You likely don't have as much appreciation, so that's why we really like the build to rent model.
Are you finding that, again, let's use Cape Coral as the example there, in your typical, are you getting a higher premium of rent per square foot for your typical build to rent home there than one might get for a newer built apartment complex?
Comparing the single family realm to an apartment complex, I don't know if I have those metrics to look at, because we don't operate real in the larger multifamily space per se.
Yeah.
But I can compare it to other houses that are older, even larger square footage. I mean, yeah, absolutely. You get a premium type of tenant. People want new, whether they're buying or renting. You definitely get a better quality tenant. There's zero maintenance on the property for the first year, and there's long-term structural and mechanical warranties. But definitely, you're getting a quality tenant demographic. and you have the highest, I guess, I think, with our leasing time frame is definitely the shortest on new construction because it's attractive. People want new. So absolutely.
How about average length of tenancy? Is it typically longer in a single family home rental than that of again, a typical apartment rental?
I would say so. Absolutely. And of course, there's a lot more things to consider as far as market,
Hmm.
neighborhood classes, things like this. But if you're in a quality area, yes, single family has longer occupancy times. No questions about it. I mean, even in areas where there's housing shortages, it's not uncommon for people to live in an apartment while they're waiting for their house to be built that they're purchasing or looking at an area. Average occupancy times for single family in Southwest Florida, we're seeing 3.5 to 4 years. Also, looking at COVID, I mean, people like their space. More people are working from home. They want to,
Hmm.
and they can even maybe take business expenses from that. So, if you're in a good location, yeah, I think a longer occupancy time with single family with new construction is probably what we're seeing compared to anything else.
Yeah, no, I agree. And then, from an investor's perspective, as I'd mentioned to you, I love the build to rent model. I love the multiple exit strategy component that exists with this model when compared to your traditional multifamily investment, right? You have a 100 unit apartment complex. Your exit is selling that 100 unit apartment complex as a whole. Whereas if you have a 100 door or 100 unit build to rent community, you've got many different exit strategies. You could sell a chunk of it and ultimately, pay down your basis or eliminate the basis, own the rest free and clear. You could sell the entirety. You could sell bits and pieces as time goes on. I mean, you've got a lot of flexibility there. So anything else that you can think of as to, why this particular model is, could be seen as a premium over that of a typical apartment or multifamily investment. And this is from like our looking from the investor's perspective in of, hey, I'm considering investing in apartment complexes or potentially a build to rent model. And I know that you guys do a lot of one-offs, but just from a higher level perspective, why would it be much more beneficial or attractive for an investor to consider, this build to rent single family home model versus that of an apartment complex?
I think it really depends, Kevin, on what their strategy is.
Yeah.
I mean, one, it's more accessible. When you're talking about single family rentals, they're very predictable. A lot of our investors, what their path is, they tend to be newer investors or they want to be completely passive, hands off. And we walk them through a process where they build a portfolio of 10 to 20 single family, maybe mix in small multifamily, and they may want to scale up and trade up 1031 into a larger complex or something like that along, down the road once they get that experience. But I think looking at the build to rent model, especially single family is very, very predictable. They appreciate very, very well. If your strategy is just to invest in an area where it's more or less maintenance, hands off, and it's more obtainable where you can have direct ownership of properties, then that's a great way to go. If you're looking at investing in a large multifamily deal, you're likely bringing in partners, participating as a limited partner in a syndication or something like that. I mean, those are large projects, and you're competing, especially right now. And I think you can speak to this a lot with a lot of institutional buyers. I mean, we're seeing cap rates really suppressed. There's a lot of demand for larger scale deals. If your goal is to partner and do a value add sort of scenario on multifamily, then great. That's one business model. But I think single family, they're much more liquid too, as you mentioned. I mean, you can sell, especially in a good area, you can sell your part of your portfolio. You can sell a single family house to a residential buyer to another investor if it's cash flowing well. You have so many exit strategies. And right now, I think we're seeing single family appreciating more than any other asset class out there, unless you're doing some sort of forced appreciation method. Just buy and hold real estate, especially new construction in states like Florida, where there is extreme housing shortages and population increases. I mean, it's just a good solid metric to buy and hold and let real estate do what it does over time.
How are appraisers looking or valuing these individual standalone single-family rental units? Will they value them on from a cap rate basis, from an income basis, or is it still the historical comparable sales approach?
It depends on what lender you're
Okay.
using. I mean, most people are using conventional financing, and in that case, yes, it's absolutely based on comps. They're not looking at any sort of income approach on it.
Okay.
So they're going to look at sales comps, and that's going to be their main metric to look at. If you had some sort of portfolio loan structure where you had multiple properties in there, they may evaluate it based on a total income perspective. But yeah, pretty much, going with the traditional appraisal method.
Got it. Good deal. What type of debt is available nowadays for your end buyers that you're selling these individual homes to? What type of debt is available? Rates, terms, what have you?
If we're holding the financing and building the house and they're just putting a deposit down, that's your regular 30-year fixed conventional financing. We've seen a slight spike in rates over time, where we're seeing, and we've all got so spoiled, right, over the past couple of years with seeing these historically low rates. We're still historically low rates and very low rates, especially when we have a 40-year high inflation rate right now. You can still borrow below that. But I mean, typical rates are maybe 4.5%, maybe 5%. If you're looking at 20% down on a 30-year fixed loan, that's still an exceptional loan that allows you to cash flow well. There's also construction financing. If you want to be a little bit more of an aggressive investor and build in a larger equity spread and actually take out construction financing, that's a bit more complicated, but we have those programs too, where someone could take out construction financing, have a larger equity spread, and then put 30-year fixed loans in place once it completes, or possibly sell the project as well.
And so how, in that particular model, so you're just acting as a fee developer at that point, or how does that work?
Yeah, I'm basically developer and builder. Yep. And they're holding the financing, and then obviously that's more risk for the client if that's what they want to do, but it also means higher reward with building below the market value.
How are you guys managing the volatility of material prices? That's got to be a tough one.
That's been something we've had to really try to narrow down over this past year. And I will say things are getting much better. Stuff is somewhat stabilized. Really, the biggest delay, especially in Florida, and any developer or builder will tell you this, really the delays are permitting in like city offices, because they're so inundated right now with building projects and they're just overworked and understaffed. But as far as to your question, Kevin, about the materials specifically, we reprice things about every 60 days, and we just need to really keep a close watch on where materials are at. A lot of things like windows and trusses can be pre-ordered. We've actually purchased facilities just for holding materials, because with our model, we know exactly how many houses we're building in 1 year, and that's our cap. And so we can, we've actually done quite well ordering materials ahead of time, where we're not subject to a lot of the volatility that we'll see. So.
Yeah, no, fantastic. And I know you had mentioned that, one of your favorite investments outside of, this build to rent or some of the other turnkey models that you guys have within your company is the retail space. So talk to me a little bit more about the various types of retail investments you like, what you like, what you stay away from. Are there certain markets that you guys are catering to as well?
We like retail that is just stabilized, areas where there's high tenant demographic, high income with quality tenant demographics, where there's growing markets. So we invest in Colorado, Texas, and Florida for retail, with the bulk of that actually being in Colorado, between Fort Collins to Colorado Springs, kind of on the Front Range. Just areas that they're growing, and you see a lot of rooftops going up. We like retail centers that usually have between 3 to 8 tenants. Standalone retail centers, obviously, if they can be shadow anchored by a large center, then that's a good location to be in too. But really, just again, in the path of progress. But that is very much, and that's on a personal level. Let's just buy it, forget about it, have management handle it completely. These are all triple net leases with 5 to 10 years left on those leases, because they're relatively newer centers. We're paying a premium for them. We get that. They're pretty low cap rates, like between 5.5 a lot of times, but those are very much a tax strategy, where we're adding them to our portfolio, running a cost segregation study on them, and then reducing our income. Our goal is to buy enough real estate every single year to wipe out our taxable income. And that's a lofty goal, but definitely is attainable if you have the right plan. And so, and this is the last year with cost segregation studies that you can take 100% bonus depreciation.
It is. What is a cost seg? What do they typically look like on a retail center that you guys purchase, as far as the bonus depreciation is concerned? That's one cost seg I have not seen as a retail center. So be interested to know.
Usually they separate out about, and this varies obviously based on location, and then the tenants exactly with, what type of personal property and how that space is built out, all varies. But across the board, typically what we're seeing is, they take about 15% out for land, which tends to be pretty realistic. So 85% of value. And we're typically seeing the lowest one we've had. So we had 7 different studies done over this past year on different centers that we acquired. The lowest one came in at, I think it was 29%, and the highest one came in at 42% of the depreciable, the improvements on the property. So that's pretty significant. I would say in general, we're usually between 30 to 35% that we're able to offset in year one of those 5 or 15-year depreciation.
I think there's going to be a mad scramble this year for investors such as us to buy as much as possible to take advantage of it's not fully going away, but it's going to start scaling down over the next couple of years. So, anyway, I'm sure
we're seeing it.
You're on the hunt just like we are.
It's a tough market out there right now.
It is.
I mean, it is. Yeah.
And what type of debt are you seeing on your retail assets? And did you see any pullback, during I guess maybe the initial stages or at all during the pandemic with lenders and their comfortability with retail assets?
It shut down completely there for a short period of time. I mean, mid 2020, financing basically came to a halt on retail specifically, and that was only, I don't know, maybe 120 days or whatever, and then they slowly started to open up because no one knew how retail was going to be affected. In fact, there's a lot of people saying, don't buy retail. One area we've seen that probably has been affected negatively and will continue to be is just regular office space.
Absolutely.
But in retail, if you're in a strong area, you're internet resistant tenants. I mean, even through restrictions, I mean, there's government assistance and retail centers have done just fine if you're in the good areas. At least ours have. But as far as loans, I mean, it was a little bit of a challenge though, 2020, but I think we're back up to full speed where we typically have a 25-year AM loan. Sometimes we can stretch that to 30 that we're putting anywhere, depending on the cap rates, the debt yield and DSCR requirements with lenders, we're probably putting 25 on the lowest to 35 or 40% down sometimes. Our goal is to put the least amount down so we can buy more and write off more. But we're typically seeing rates in that about 4% right now with maybe 30 to 35% down. Mm-hmm. And that could be a 5 to 7 year term, 10-year term, possibly depending on those leases. Sometimes they have prepayment penalties. One thing that we got into trouble, not trouble, but I wish we would have done differently with a couple of retail centers is we really stretched the LTV to 75%. And it was a $10 million purchase on 2 buildings. And we really wanted that 75% LTV. And then the lender had all sorts of covenants that really just restricted. They had a 10% liquidity covenant across the board across all our contingent liabilities. So that means we just have money sitting in the bank doing nothing.
Yeah.
And I hated that. I wish we would have done that. And we got a 5-year prepayment penalty on it. So we're just going to have to ride that one out likely. But
so most of these banks you're working with are local banks or credit unions, what have you? Or you're not really.
Both. We've worked with national and local credit unions. Usually local credit unions will offer the more attractive terms.
Yeah. So no CMBS or anything like that.
Mm-mm.
Good deal. So yeah, I was shocked at, it's interesting because we know that office I feel like is a little bit of a delayed reaction because, leases are still being paid, but inevitably, when renewal periods come up, the fat lady will come to sing. We just don't know how loud she's going to sing, right? As a restructure happens with workers, employees getting back to work, will there be more square footage per employee? Will there be still like a hybrid model where some are working from home, some always stay home, some are at the office 100% of the time, some are 60-40? We just don't know what that looks like. But it was interesting that the mayor of New York City is ultimately really putting a lot of pressure on some of the larger CEOs and companies there in the city itself, basically stating like, you guys need to put together an action plan to get your employees back in these offices, because only 25% of the workforce is actually back in the city, right? And the local retail and everything else that's supportive from those workers being there and spending money at breakfast, lunch, dinner, what have you. They're dying. They're absolutely dying. And so it's going to be interesting to see how that plays out, not just in major cities such as New York and Chicago, but really across the board. I think there's going to be there will be a bloodbath of some sorts. I don't know what that looks like, but there will be a bloodbath in office. I think we can all agree upon that. And retail, not so much. I mean, I think the retail assets that suffered during COVID were already, they already had a couple like nails in the coffin, right?
That was a breaking point. Yeah.
Yeah,
Yeah.
they were bleeding a little bit, and it just, COVID kind of just ripped the band-aids off and made it happen a little quicker. So, well, that's exciting. So, well, good for you. And looks like you're still getting a pretty good spread there, 150, 175 basis point spread on from what you said they're selling at cap rate wise. And these are stabilized assets. And I guess, what is the long-term game plan with some of these retail assets that you're buying, personally? You've got 5 to 7 year debt on it. No one knows what the capital markets really look like 5 to 7 years from now, which, one could say that that's a risk, or it's, we just don't know, right? Like, there's so many uncertainties here as the years trickle on, and as rates potentially go up, which cap rates, will they follow suit, what have you? But what are your thoughts as far as long term? Are you buying these things with the intent of holding them for decades, or do you typically have like a 5 to 7 year exit where you'll exit out 1031 to something else at the end of the road?
It's always important to keep your money dynamic and moving. And I think that's really at that snapshot in time, a decision that we'll probably make. But very much the intent, I think, for the asset class that we're trying to acquire right now is a long-term hold basis. Again, inflation at all time or 40-year high. We're seeing, if you're in the path of progress in some of these areas where there's large population trends, and we're seeing housing shortages, those are good areas to be in long term. Those commercial rents will go up over time, especially with new construction. I mean, as new construction comes in, those rents are almost unattainable for some tenants. But yeah, our goal, Kevin, is to hold long term. We've already done accelerated depreciation, so we need to hold them or 1031 out of those over time. But I think even if interest rates go up, I mean, holding them for a 5, 7, 10 year period on that, whatever that loan term is, that's paying a significant amount of the debt down during that period of time, especially on a 20 or 25-year AM. And so interest rates, so what, doesn't matter. Rents will increase over time. There's still going to be positive cash flow. Maybe we put a new loan structure in place. Who knows? We're probably going to hold these things for a long period of time, and unless there's a can't pass opportunity.
Sure. How do you manage the downside of being in a fixed rent type of asset with annual escalations in place, and we find ourselves in such an inflationary environment, but ultimately that's not going to continue on for the next 3, 4, 5 years, like at the rate that it is at present. I'm not an economist, but one would say that it's probably the case. Like, it's not going to continue on at 20 or 20+% year after year for the next 5 years. Yeah, I know.
Yeah.
Right. But again, being that, most of these leases, you've got probably 3, 4, 5, 6, 7, 8, 9. I mean, you got a long term remaining, and fixed escalators in place for annual increases. How do you manage that downside? Is there a strategy around managing that to the best of your ability? Is there I don't know the answer to that, but so, like, anyway, there's many other people in your shoes. So how does one manage that downside risk?
And what downside risk are you referring to?
Meaning that if
with
you've got
those?
only 3% increases on an annual basis, I mean, if you've got rentals, single family rentals, you're able to reset the rents on an annual basis. Whereas,
so you're talking about the market value increasing
absolutely
beyond what the
yeah,
escalator is.
Yeah.
Yeah,
So
I
if you got a 7-year lease and you've only got 3% annual increases set in place, I mean, you're at 3%. But let's say inflation's at 12% next year, 9% the following year. And again, you're not able to keep up with the market rates.
I mean, if you're buying it right today, and it makes sense today, and you'll have those rent escalators over time, then I think you're okay. I don't view that as a risk. If anything, that's probably going to, and those leases will come due at some point. You can actually renew those leases earlier and approach tenants about that, potentially. But I think that actually makes that property more attractive if all of a sudden that rent is now under market based on what's happening around it,
There you go.
and probably will
that.
encourage that tenant to renew. But if you're buying it, it makes sense today, before any escalations, before market increases, then you're in a good position, and you'll come out better when it is time to release.
Yeah, I like that. Glass half full. I love it. I mean, use that as leverage to get a renewal in place with the tenant. I love that. Well, good deal. Well, man, it's been a lot of fun having you here, Zach. For those that want to learn more about you and what you got going on, where's the best place to find you?
Yeah, the best would come through, or whether someone wants to just talk shop about commercial, or interested in the build to rent, which is a very exciting opportunity, or some turnkey investment properties, they can visit our website. That's renttoretirement.com, renttoretirement.com, I think, is the best way to learn more about us. Get in touch. We'd be happy to have conversation. We've got a great team of people doing exciting things across the country.
All righty. Well, fantastic, Zach. It's been a lot of fun having you here, my friend.
Thanks so much, Kevin. It's been a pleasure.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.